Trading YouTube is full of promises. They tell you that if you just learn the silver bullet setup, if you just trade the 10 a.m. to 11 a.m. window, you will print money. They tell you to aim for a 1-to-2 or 1-to-3 risk-to-reward ratio, set it and forget it. It sounds perfect. It sounds mechanical. But there is a problem. Most of the people teaching you this have never back-tested it properly. They show you a few hand-picked examples from last week where the market trended perfectly. They don't show you the choppy months. They don't show you the losing streaks that destroy funded accounts. I don't trust gurus. I don't trust feelings. I trust code. So, I decided to do what 99% of traders are too lazy to do. I wrote a custom Python script to analyze 5 years of tick data on the Nasdaq. I didn't just look at the wins. I looked at the ugly truth, the commissions, the slippage, and most importantly, the psychological pain of the drawdowns. What I found completely changed how I trade the New York session. And if you watch this video to the end, it will change how you trade too. Let's look at the data. Before we look at the profit and loss, you need to understand how this test was built. If the methodology is flawed, the results are garbage. Most backtests you see online are manual. A trader scrolls back in TradingView and says, "Oh yeah, I would have taken that trade." That is called hindsight bias. Of course you would have taken the winning trade when you can see the future. My script is different. It is blind. It has no emotions. I programmed the exact rules of the ICT Silver Bullet. 1. We are only looking at the 10 a.m. to 11 a.m. New York local time window. 2. We are looking for a fair value gap created after a liquidity sweep or a market structure shift. 3. We enter at the retracement into the gap. I ran this algorithm across thousands of trading days. I simulated spread costs. I simulated the reality of execution. I tested multiple risk-to-reward ratios, 1-to-1, 1-to-2, all the way up to 1-to-5. I wanted to answer the ultimate question. Is it better to be a scalper taking quick profits, or is it better to be a swing trader holding for the home run? The answer is not what you think. Let's start with the most popular advice. The 1-to-2 risk-reward. Let's look at the standard model. Every guru tells you to aim for 2R, 3R, or even 5R. Risk 10 handles to make 20, 30, 40, or 50. Mathematically, my data confirms that this is a profitable strategy. Across 5 years, the expectancy is positive. You will make money eventually. But look closer at the data. Look at the win rate for the 2R ratio. It sits right around 35%. Now, a 35% win rate is acceptable for a hedge fund, but for a retail trader sitting at home, it is a nightmare. Why? Because of the distribution of wins and losses. Look at this column here. Max consecutive losses. The number is 12. I want you to really think about that number. 12 losses in a row. Imagine, it is Tuesday. You take a loss. Wednesday, another loss. By Friday, you have lost 4 trades in a row. You come back next week trying to be disciplined, and you lose 4 more days. Most funded account challenges have a maximum drawdown rule of 5% or 10%. If you risk 1% per trade, a 12-trade losing streak blows your account. You are out of the game. Even if you risk 0.5%, can you psychologically handle 2 or 3 weeks of red? Most traders can't. They will start revenge trading on the 5th loss, change their strategy, and blow up. So, while the 1-to-2 ratio makes money on paper, in reality, it is a widowmaker for retail traders. So what happens if we drop our ego? What happens if we stop trying to hit home runs and just take what the market gives us? I ran the same simulation targeting a 1-to-1 ratio. Risk 10 to make 10. The win rate immediately jumped. We are looking at numbers closer to 54 to 57% on good days. The expectancy per trade drops slightly compared to the 1 to 2 model because we are capping our winners. But look at the equity curve on your screen. The blue line is the 1 to 1 strategy. The orange line is the 1 to 2 strategy. The blue line is smoother. It is less stressful. The maximum losing streak drops significantly. For a beginner trader or someone trying to pass a prop firm challenge, volatility in your equity curve is your enemy. You don't need the strategy that makes the most money in 10 years. You need the strategy that keeps you alive today. However, even with the 1 to 1 ratio, there were periods where the strategy stagnated. I dug deeper into the data to find out why, and that is when I found the anomaly. This is the most important part of the video. This right here is why you are losing money. I broke down the performance by day of the week. I expected the results to be random. They were not. Look at Thursdays. Specifically, look at the 1 to 2 ratio performance on Thursdays. The win rate drops to 34.34%. Think about that. On Mondays and Fridays, the algorithm is giving us win rates over 40% or even 57% on the lower ratios. But on Thursdays, something breaks. Why? We can speculate. Maybe it's because major economic news like unemployment claims often drops on Thursday mornings, injecting chaotic volatility that hunts stops before moving. Maybe it's because the weekly profile is reversing. But as an algorithmic trader, I don't care about the why, I care about the what, and the what is clear. Thursday is a losing day. If you take a 34% win rate strategy and you add commissions and spread, you are mathematically guaranteed to lose money over time. If you are trading the silver bullet blindly every Thursday, you are taking the profits you made on Monday and Tuesday and lighting them on fire. So, how do we fix the silver bullet? How do we turn this from a break-even struggle into a consistent income system? Based on more than 5 years of data, here is the optimized plan. Option A for stability. Stick to a 1 to 1 reward ratio. It buffers you against the volatility and keeps your drawdown low. It's boring, but it pays. Option B for growth. You can aim for the 1 to 2 ratio, but you must apply the Thursday filter. Simply do not trade this setup on Thursdays. Go for a walk. Study charts. Do anything but press the buy button. By removing that one statistically negative day, you eliminate a huge chunk of your losses, your average win rate climbs near to 40%, and your equity curve smooths out. This is the power of quantitative trading. We don't guess, we don't hope, we optimize. I have uploaded the full raw data sheets and the Python code used in this video in the description below. Download it, verify it for yourself, and stop donating your money to the market. If you want me to backtest another famous strategy, drop it in the comments. I'll let the code decide if it's legit.